Hello there, Ross Levine.
Hey Glenn, how are you?
I'm very well. This is Glenn Loury, and you, Ross, are my second guest on the Glenn Show at bloggingheads.tv, which I'm very proud to have gotten underway.
Yeah, congratulations on your new show. I think it's wonderful.
Thanks very much. I am Glenn Loury, professor of economics at Brown, and also here at bloggingheads.tv, and happy to have with me today to talk Ross Levine, my colleague in the economics department at Brown, a professor of economics and an expert on financial economics, joining us to talk today about is Mitt Romney too rich to be president? How did he make his money? What is private equity all about? How come he's and others like him pay such a low tax rate? Should it be so? What's the role of the financial institutions and the financial industry in either generating inequality in our society or in helping to reduce inequality and expand opportunities, that sort of thing. Finance and inequality, that's the theme I see for us today, Ross.
Great. That's great.
Great. So why don't we start with what's in the news these days, which is leading Republican presidential candidate Mitt Romney, his huge fortune, at least $250 million is what I'm reading in the newspaper these days.
Yep.
He made his money largely through his work at Bain Capital, a firm that he founded some years ago, which engages in leveraged buyouts and private equity type deals.
Yep.
And he made quite a bit of money and is still being compensated very generously from that firm for the work that he did there. Can you help us understand a little bit about how that industry works, what these guys do, men and women do to earn their money, and whether or not you think the criticisms of Romney and the work at that firm, vulture capitalism, not venture capitalism, is what one unkind critic has said, whether or not those criticisms are warranted. What do you think?
So let's just start with the basics of what these institutions do. So private equity refers to two different types of activities. So one is venture capital. So a firm is starting up. You have a good idea to improve a certain technology. You want to start a business. You go to a venture capitalist, which comes under the heading of private equity. They invest in your firm, they give you management advice, they help you raise capital from other sources.
Yeah.
That's actually a very small part of private equity. So private equity probably finances at its peak, financed about $300 billion worth of investments, and venture capital was very small, less than 10% of that. The majority, like you said, is a leverage buyout, and so there's an existing firm.
Yes.
And perhaps it's underperforming, maybe it's going to go out of business, it's just not doing very well or as well as a private equity firm thinks it can do. And so the private equity firm raises money through a variety of sources and it buys the firm. And then the way it makes its money is it improves the functioning of the firm and then sells it back into the market at a higher price. And by doing that, it can make an enormous amount of money.
In those cases where the restructuring or other changes that they bring to the firm are just so effective at increasing the value of the firm, and then they get to share in that increased value when they sell on the back end.
Exactly. So there's a firm, maybe it has a bad management team, it's made a bunch of bad investments, and it has some good opportunities, but because it has a bad management team, it's having difficulty attracting loans to exploit those opportunities. Private equity firm raises money, buys the firm, maybe gets rid of bad managers, puts in place good managers, helps the firm raise capital so it can invest in high return ventures, and the firm then becomes very attractive, and the private equity firm can sell it in the market, and in some cases can make enormous amounts of money.
Okay, let me ask what may seem a naive question, but these are guys, I suppose they are mostly guys. These are men and women sitting around in Boston or New York or somewhere. Mm-hmm. What makes them so smart? I mean, how is it that they know better than people who for 20 or 30 years have been laboring in the the widget industry, have been making widgets, have been running widget firms. How is it that financiers know better than widget makers how to take over and better run a widget firm?
Yeah, so this is a good question, and I don't have the answer because I'm not involved in that. But you can look at a firm in an industry that's profitable, and you look at a firm and it's unprofitable, and you look from financial statements, you look at their balance sheets, and you say, my goodness, why is this firm's earnings so much less? You can then go and talk to the management of the firm and make an evaluation that there's possibilities here. This firm really could do better if it exploited these opportunities and if it got rid of these impediments to growth. And so it's risky because, like you say, the insiders in a particular venture might have more information about those specific technologies. But what these financiers have is, from time to time, a better perspective of how this company moving forward strategically can do better. So, for example, I might be comparatively good at making PowerPoint lectures on financial institutions,
right.
But I might be a really poor manager at taking what I do and selling it in the marketplace. And somebody might come and look at my skills and say, he has some pretty good technical skills on this front, but he really doesn't know how to run a business. He doesn't know how to attract capital. He doesn't know which markets to exploit. And so I'll actually come and take over Ross's firm, use Ross's technical skills, and perhaps hire Ross as an employee, but he's not very good as a manager.
Okay, well, I get that. And one implication, it seems to me, of that is that, okay, you say private equity firms do two kinds of things. The lesser of that is venture capital, where there are new ideas or new enterprises to be launched, and they're trying to raise money. And the private equity firm, as a venture capitalist, helps them get capitalized. But then the other thing is this buying out, taking over, restructuring, and then selling. And the implication I want to call attention to is, it seems to me they can't possibly make money doing that unless they actually create value. Right.
So there's where sort of some of the criticisms come in. So the creation of the value is that, okay, here's a firm, and like I pointed out, maybe it's a firm and it may be technically adept but not very good at business. Okay. And so they're going to come in and they're going to do better on business. The other thing that the firm may not be very familiar with is how to raise capital and invest it wisely. So this firm might have opportunities, but it might not know how to go about raising more debt in order to exploit those opportunities. So the private equity firm comes in, and part of what it might do is borrow a lot of money, and hence this term leverage. Yep. So the private equity firm will borrow a lot of money, take over this company, and then try to improve the management of the company, and then sell it going forward.
But they can't make money unless they sell it for more than they bought it at.
Absolutely.
Am I not right? And so if they do that, they must have persuaded some buyer that the firm is now worth more after they've intervened than it had been worth when they acquired it. It sounds to me like they're doing something productive.
Exactly. And so this is, you could call this, this is sort of the market at its best. There are some firms, some managers who are not operating effectively, and so a private equity firm will come and buy them, make them operate better, and sell them in the market for a profit. Sometimes they're going to be successful, and many times they're going to fail. But that's all part of this intense competitive process that we have in a free market. So that's sort of the good story.
So far, so good. Yeah.
And then there can be problems. And so one of the points that I made was that the private equity firm is going to borrow a lot of money in order to buy this company. The entity essentially that's going to owe this money back to the market is the company itself. So there's a sense in which the private equity firm's borrows on behalf of the company so that the private equity firm can buy the company. So this company typically ends up with much more debt.
Can we just slow down a minute and maybe you could explain this a little bit more fully, because I'm not sure I understand it. I know the charge. The charge is that the firms are saddled with a lot of debt, and these gunslinger private equity types have gotten in, gotten out, got their money, and and then they've gone home. Meanwhile, the firm languishes because it's burdened with this debt, and it might go under because of the debt that it was burdened with at the point of the initial transaction.
Yep.
Is that an accurate charge, at least some of the time? And why would people loan money in a situation where there was some chance that a firm was going to fail and they wouldn't get paid back, and so on? I mean, and moreover, how is it any different if the private equity deal makers are actually in control of the 51% of the shares or whatever? I mean, the firm borrowed money because they thought they were going to make a return on the loan. They didn't do anything wrong by borrowing.
There's not necessarily anything wrong, and borrowing is not necessarily bad. So let's say Glenn Loury has a firm and it's not operating very well, and Ross Levine decides to buy Glenn's firm.
Yeah.
So what happens is Ross will set up a new company called Glenn 2. And Glenn 2 will borrow a lot of money in order to buy Glenn.
Got it.
And so now there's essentially a new company, which is Glenn 2. Glenn 2 is exactly the same as Glenn in terms of it produces the same things at the initial point that Glenn 2 buys Glenn. It has the same in employees. Nothing has changed except now Glenn, this new company, does owe more money. The debt is increased. This is the nature of a leveraged buyout. Okay, but you've been purchased, so you kind of got your money, and you might still work at your company, but you are no longer the owner. I, as the owner of this new Glenn 2 company, am the owner of the firm.
Now, the reason that we've transferred ownership from Glenn to Ross, who owns Glenn 2, which owns the company Glenn, the reason we transferred ownership is so that the decision-making about the deployment of my assets, the assets in the company that Glenn originally owned, will now reside not in my hands, but in the hands of whoever is controlling the board of Glenn 2.
Exactly. Exactly, except Glenn 2 is no longer a public company in the sense that it doesn't necessarily have a board in the sense that a public corporation traded on the New York Stock Exchange has a board. So this could simply be, now that I've bought it, I could simply be, I could constitute the board as I see fit.
Oh, I've been taken private now in addition to having been taken over.
Correct. So I paid you money. I've taken the firm private. I still may want Glenn for his expertise, but you are no longer...
I'm an employee, not an owner anymore.
Exactly.
Anyway, we were talking about the leverage buyout and about how the acquired company gets the debt that gets responsible for repaying the debt that is acquired by the private equity people when they come in and do the deal in the first place.
Right. And so now I own this new company, and I'm going to make whatever change I think I'm going to make this new company, Glenn 2, operate better. Now, Glenn 2 does have more debt. One of the advantages of debt is that it's tax deductible, so that helps on the expense side of things for the company. I make the changes that I want, and then I'll take the company public again if I can, and sell it.
Now that debt is counterbalanced by, because the money went somewhere, it went to compensate Glenn for turning ownership of the firm over to the private equity.
Exactly. So some of it will go to you to pay you out, and some of it might be raised in order to take on additional investments, because this firm might have opportunities that had not previously been exploited. And now with this new capital that was raised by the private equity firm that took over Glenn, they can now exploit these new investment opportunities. And so...
So I'm coming to conclude here then that the charge that private equity people or vulture capitalists who acquire firms, pick them clean, and then leave them laden with debt, is a canard. That it's not a valid criticism of what's going on.
Well, then there's sort of...
It's like they're only taking the losing cases. That the firms that after the debt is acquired turn out not to become profitable and eventually have to fold up or shrink or be acquired at a lower price.
Right.
Those are the losers. Right. And in those cases, you might say, yes, the taking on of the debt really did burden the firm, and it turns out that the firm was never able to pay it back properly.
Right.
But they wouldn't be in business for very long if all of their deals were losers. So there must be also winners, and in those cases, the acquisition of the taking on of the debt was just a necessary part of the process of restructuring the firm and getting it in shape to become profitable.
Yeah, that absolutely, and I think that the bulk of private equity and leveraged buyout transactions involve risk taking in order to improve an enterprise. With potentially positive ramifications on the economy. But there are legitimate cases where the term vulture does hold, but I don't think that that's the majority of the cases. So,
but how does that go? What are some of those cases where vulture capitalism is really what's going on?
So what can happen, and this sort of involves certain quirks in both the bankruptcy law, and it relies on something that you mentioned earlier, and that is, are there unsuspecting entities that lend money to these private equity firms? Okay, so one thing that can happen in bankruptcy is the following. So let's say Glenn is running his company, or General Motors is running its company, and the company builds up enormous pension fund liabilities.
Okay.
And those pension fund liabilities make the company borderline profitable, and so it's kind of just on the fringes of bankruptcy. Now, this company would be very profitable if it did not have those pension fund liabilities.
Right.
So if a private equity firm can identify a situation like that, borrow money in order to take over the firm, such that the additional debt actually pushes the firm into bankruptcy. And in bankruptcy, the private equity firm can induce the bankruptcy courts to shed the liabilities of the firm, pension fund liabilities and often debt liabilities, and yet retain control of the firm that comes out of bankruptcy. Then the private equity investors can potentially earn quite a bit of profits.
And they will have earned the profit by forcing on the unions a renegotiated set of pension obligations that the unions might never have been willing to agree to in open bargaining, but that the bankruptcy court has the power to impose.
Exactly. And so then what might happen is that some of the pension fund obligations would be pushed actually onto the government, the Pension Benefit Guaranty Corporation, but the pensioners would receive only a fraction of what was promised to them, and then the company would come out without those obligations. And so so some people looking at that might look at that as exploiting certain quirks in order to extract a large profit, rather than as adding value in the same sense that we talked about earlier, where a private equity firm has a better strategy for running my firm, takes it over, earns a profit in fixing the firm, and therefore having this very positive effect on the economy. This is a little bit more like exploiting, something that doesn't quite work as socially effective in the bankruptcy laws. So that's one.
Yeah, it's a complicated example because the bankruptcy court is playing an independent role.
Correct.
And I assume that those judges are constrained by whatever the legal framework is, what the statutes say, and what the precedents of the higher courts will have said. They don't have just free reign to impose anything that they want.
Correct. That's right. So the point here is not that the private equity firm is doing anything illegal, or that the bankruptcy courts are doing anything illegal, but it doesn't quite have the same feel that, okay, these people are identifying weak firms, fixing them, and then selling them into the marketplace. This is a little bit more like, there are these quirks in the law, I'm going to exploit it and make money. Both are legal, but there's a different connotation that we might interpret them differently.
Yeah, I see. Now, what about job loss? That's another. We've been talking about saddling these firms with debt and vulture capitalism, but what about the idea that the consequence of the deals that the private equity firms get into is to end up destroying jobs? He destroyed X number of jobs. He created Y number of jobs. It's kind of political talk. Do you think, in your view, is that a fair charge about the activities of Bain in particular, and of the private equity industry more generally?
So the empirical evidence on this from academic studies suggests that there's not much of an employment effect. So yes, if there's a firm that's not doing very well and a private equity firm takes it over, part of the way in which it's going to make that firm work better is to get rid of inefficient workers. At the same time, as I mentioned, a private equity firm, when it takes over a firm, it might also see areas of expansion, and those areas, when it expands, that might involve an increase in the number of individuals working for the firm. So those things tend to balance out to some degree. But I think that those studies miss an important point, which is that if a firm is not doing very well and it's going to go bankrupt, those jobs are going to be lost. And so if a private equity firm can fire some of the workers and keep the entity operating, then in some sense it's saving those workers, at least some of those workers, by making this firm profitable going forward. So
okay, so this is really an important point, I think, because it goes to how you want to interpret the effect on employment, the net effect on employment of the private equity intervention. And it could be that net effect is positive, even when the consequence of private equity coming in is that the firm employs fewer people after the fact than before. Because had they not come in and done the restructuring, they may have been employing none. So the right comparison is to the counterfactual, what would employment have been had there been no intervention, not to the ex ante, what was employment before the intervention.
Right. Exactly. I mean, that's exactly right. And I don't think that the people doing these studies are very good. It's not that they're not aware of it. I just think that doing it is very difficult. And so what they do is they try to take firms that look about the same and see what happens to their employment. One comparative group that is not taken over by a private equity firm and another that is, and they find that on net there's not too much different, but that really is not controlling for the fact that this firm might actually be on the precipice of failing. So they recognize this, and so I think private equity should be judged differently just from sort of this bottom line that doesn't seem to have too much of an employment effect.
But it sounds like the direction of the adjustment would be in favor of the private equity. That is to say,
I think so.
If the academic studies show that the net effect on employment of private equity deals is like about a 1% reduction in the level of employment in the firms that are taken over, which is what I got out of the abstract from one of these studies. If that's the case, then your point is that, but the real effect might even be more favorable to employment than that 1% reduction, because these companies might have gone completely out of business had they not been taken.
Exactly.
So the bottom line here is that the charge that the private equity deals is coming in and leverage buying out and the restructuring destroys jobs. The evidence suggests that that's not so.
I think that's my interpretation of the evidence. Now that doesn't mean that the general partners in private equity firms are compensated in a justifiable manner. So this is this other thing that's been in the press about Mitt Romney paying such a low tax rate on his earnings. So
okay, well, let's move to that, because this is now yet another sub-theme here. 15% versus whatever the marginal tax rate on the typical worker is, 35% or whatever it is. How come people who are making their money in private equity are paying such carried interest? Isn't
exactly.
that the term of art? So what's going on there? And are those provisions of the tax code justifiable, or do they merely reflect the lobbying influence of the financial industry? Is that a playing field that's tilted? Is that a fundamental unfairness?
Yeah. So
those kind of
so
questions.
let's sort of like in many things, we sort of have to peel this back a little bit. But in the end, I think Jon Stewart said it best when he said something like the rich have really good lobbyists, and the lobbyists for the poor really suck. And so I think that that's going to be the essence, the bottom line of all of this. But so in the tax code now, there's the tax rate on capital gains is 15%, and the tax rate on income, depending on how much you make, is much higher, perhaps double. So one can argue about that. So the reason why capital gains is taxed as 15% is, okay, you put your money at risk. This innovation is what creates new jobs. It creates progress. And so we're going to tax capital gains only at 15%. So that's sort of a decision that was made in terms of the tax code.
Okay, just to be clear, a capital gain is a person owns an asset. After a period of time, the value of that asset increases. Yep. They sell the asset at the higher price than what they paid for it. The difference is a profit to them. It's income, and that's what people are calling capital gains. The income associated with the sale of assets which have increased in value during the time that a person has held.
Exactly. And so I think that they don't want to call it income, because income they want to think of as income from labor, and they want to think of that other stuff as capital gains.
Okay, now, but capital gains are different from interest and from dividends.
Capital gains are different from interest and dividends. That's correct. Okay. So that's the tax code. So one debate is whether there should be this difference in taxes. But that's the.
So you want to put that to the side?
I want to put that to the side just to get at what this carried interest is for private.
Although we economists do have theories about why it is that you might not want to tax these different sources of money coming into a person at the same rate.
Exactly. Now, with private equity, you can see from the examples we were talking about that you could say, okay, private equity firm, Mitt Romney kind of comes with his own money. He buys Glenn's company. He fixes, Glenn's company, and he sells it back into the market, gets a return, and that return, might be viewed as a capital gain, and hence would be taxed at 15%. So that's, I think, the essence behind why private equity firms and hedge funds are taxed at 15%. But there's a problem with that narrative. The problem with the narrative is that the private equity firm doesn't directly buy out Glenn with its own money.
They get Goldman Sachs to invest $500 million and then buy Glenn.
Exactly.
That.
So
they might have put in $5 million or $10 million.
Right, but they actually, on average, the general partners in a private equity firm, if they're going to buy Glenn's company, they only put in about 1% of the money that's needed to buy Glenn's company.
Okay.
But they are promised typically 20% of the gain in value when they ultimately sell Glenn's company back to the market.
Wow. So again, if Glenn's company is worth $500 million, they may have put in $5 million of their own money, and then they've gone around to a bunch of wealthy institutions and investors and solicited funds from them to get up to the $500 million to buy Glenn out. But then when they turn around and sell, I don't know, they may make 3, 4, 5 times their money, and that's going to be accruing as a capital gain because it appears that it is the result of the increase in the value of the shares in Glenn's firm.
Exactly.
But in fact, what you're saying is they're being compensated for their labor.
So that's the tricky part, and that is that this is not a pure capital gain in the sense of they buy in 10% and then they get 10% of the gain. They're buying in 1% and they get 20% of the gain. The way they justify, the way it's justified, they don't have to justify it, the way they justify it to their investors is that they are the ones who chose this firm. They are the ones that are going to make the decisions about improving this firm, and that therefore they deserve a large percentage of the upside return. And so this is kind of a private arrangement among investors. That's perfectly fine. However,
the investors are letting them take more than their proportionate stake out of the gains, because there would have been no gains whatever without their cleverness, their insight, and their, and their ingenuity.
Exactly. So you and I might get together. You might think I'm pretty good at fixing that company, and you're not good at fixing that company, but you give me some money, so that I take some of my money so I can fix the company. You might give me a higher percentage of the gains. And you and I.
But you'd never be able to persuade people like me to keep giving you money to invest unless we were satisfied with the net returns we were getting, even after you got your outsized compensation.
Exactly. So while there's one,
you're still making money for me.
Exactly. So while there's one, that's true. But there's. Let me go back to one thing, and then we'll come back to that part, because that's actually a key part that's not discussed very often in this. So this is all well and good. You and I make this deal. I get 20%. You get the rest. Fine. The question is that it seems that part of my compensation is coming from the fact that I provide my expertise.
Right.
And so that expertise is, just like you provide your expertise as a professor of Brown in the classroom, you don't get a capital gain associated with the increased value of the enterprises that your students run or whatever. That's income, and you get taxed at the 30% or whatever, not at the 15% capital gains. So there's a question about whether what the general partners in a private equity firm are providing is capital, or a little bit of capital and a lot of expertise. And if
I see.
So should they really be taxed at 15%, even if we accept that capital gains gets taxed as 15%?
Yeah, because what is formally a capital gain, that is to say, it is the increase in the value of some asset that they own, is in fact a return to their human capital. It's a compensation for their labor services that just happens to be paid in the form of a capital gain and so taxed at a lower rate.
So that's why there's some debate about this 15%. And that's why, that's why Mitt Romney gets paid. That's why Mitt Romney is taxed at 15%, and that's sort of the that's the essence.
So just to make sure, if I could somehow persuade Brown to allow me to, students get into my class if and only if they're willing to sign on to say that I get 5% or whatever their company is worth. Now, of course, students don't all have companies. But if I were teaching in a business school, or something like that, and so I become a little part owner in whatever the enterprise is that my students are going to subsequently go off and start. And some will be successful, some will fail. Those who succeed, the value of their enterprises will increase, and my little shares will increase in value. Those will be capital gain for me, and if my compensation were paid in that way, I'd be paying a lot less taxes than I actually pay for the same gross compensation paid as a salary from Brown University. I was just trying to, summarize in my own words by using this example. If I could get a share of my students' future earnings somehow as an asset, and if I did a good job teaching, some of those students' value would go up over time. And then if I got my compensation by the increased being able to sell my shares in the students' future earnings for more than they would have been worth when I first acquired them, that would be a capital gain, and then I'd be taxed at a lower rate than I'm actually taxed at.
Yeah.
And somehow the private equity industry has configured itself in such a way that people who go to work there and who are basically getting paid for the labor services that they provide are able to realize those payments in a form that is taxed at a
Yes.
lower rate. Perhaps they shouldn't be able
Yep.
to do so.
Yep. So I think that there's a lot to be a lot of value added associated with people looking around at firms that are underperforming, buying them, improving them, and selling them back into the market. I mean that's a part of an efficient functioning market. At the same time, you could have these entities could be compensated in a manner that doesn't seem quite fair. And so I think that's part of why people have a reaction to Romney's tax rate, not necessarily too much of a problem with private equity as a way in which he was employed.
But the reaction is different, is it not, from observing that capital gains are taxed at a lower rate than labor income?
Yes.
Because the observation is that these guys are kind of gaming the system in order to get their labor compensation in the form of capital gains so that it can be taxed at a lower rate.
No, this is very true. And there's something self-servingly inconsistent about kind of Romney's statements here, because you have, for example, Warren Buffett, being taxed at a very low rate, and he comes out and he doesn't voluntarily pay more taxes, but he sort of says, hey, this is really not quite right. And that's the type of response you might want from somebody who wants to be your president. It's like, okay, I worked in the private sector. Here are the tax implications, and this is what I did. But maybe there's something not quite right. But Romney was actually a little bit different because he lobbied for the tax treatment of the general partners in private equity funds and hedge funds to remain at 15%. He kind of lobbied for...
Lobbied whom? When did he do that?
After he left... I think it was after he left the governorship, when he was a private sector individual, and I think he lobbied sort of Congress in order to maintain this tax treatment of private equity firms and hedge fund managers. And
why? What were the arguments other than self-serving arguments? What might have been legitimate, arguments about why it would be good public policy to maintain?
Yeah, so I think that the argument for this is that you say, okay, we need capital investment in order to push the economy forward, in order to encourage capital investment. We're going to tax capital gains at a lower rate, this 15%.
Okay, so that's the capital gains part, but that's not the carried interest.
Right. So I think the argument there is that that yes, they are being. That the argument is that the primary returns that they're making are from this 1% equity stake, not from their labor income. And I find it a little bit of a stretch, but the argument is that they are, in some sense, enhancing the capital, that they are improving the capital in a way such that they deserve to be taxed at a lower rate. That this is yes, they get a higher percentage of the returns, they get 20% and they invest 1%, but this is all part of a private contract in which they're buying a firm and improving it. And the alternative argument is, yeah, that's fair, you're investing your money and getting a capital gain, but part of this is simply the result of your labor income, which in that case you should be taxed, the way all of us are taxed when we...
Well, yeah, exactly. This is what I'm thinking, right? I mean, I'm saying, suppose I have, two classes of people who've invested in the deal. Some of them are the private equity guys who brought the deal to the attention of the other investors who structured the deal, who are going to oversee it and try to make sure that it becomes profitable. And then the others are, pension funds or deep-pocketed individuals who just are looking for some place to put their money. Now, both of these people are investing, and they're both going to realize capital gains. But the first class, if they're getting 20% with 1% of the money going in, are getting a much higher return on their investment than the other class. And so while these returns are both in the form of capital gains, there's something observably different about the capital gain realized by the private equity people than about the capital gain realized by the passive investors. It's a much higher rate of return. Why couldn't I make the 15% tax treatment of capital gains apply to that part of the private equity partner's earnings, which was at a comparable rate of return to what all the other investors in the project were getting? Those are, I'm going to just call them pure capital gains. And then the other part of the return that the private equity partners are realizing because of their expertise, while it is, formally a capital gain, it's a kind of excess capital gain, which is really a return to labor. And I'm going to tax that the way I tax a working stiff's wages.
I think that's it.
Why couldn't I do that?
You could do that. but
it seems to me that the people who say we need to attract capital and we need to encourage people to take risks wouldn't be able to argue against my doing that, because I'm just going to treat all capital that comes to the table, that I want to encourage to come to the table, in the same favorable way, and not allow the private equity people to sneak their labor earnings under the wire and call it a capital gain and get special tax treatment.
I think on this one I'll say that I was right in quoting Jon Stewart. The rich have good lobbyists and the poor have really sucky lobbyists, and so this is sort of the tax code that we have.
Okay, now let me just ask you something else, because my impression is that both Democrats and Republicans in the United States Congress have been friends of the financial industry and supporters of the special tax provisions. I somehow recall, for example, Senator Charles Schumer, who does represent the state of New York and therefore represents, the financial industry in New York City, not having been in favor of changing the tax code so that hedge fund managers and private equity partners and such, being against changing the code to raise the tax rates on such people. So it's not just the Republicans. That's the point I'm trying to make.
Yes. No, Democrats like money too.
Okay, Ross, I think maybe we've got a few minutes left. I'm wondering if there aren't some more general observations we want to make in this conversation about the relationships between, we've been talking about the very wealthy, we talk about private equity partners such as Mitt Romney, talking about special tax treatment, their earnings, understanding where their money comes from and how their deals work and what the net effect on the economy of their deals are and so forth and so on, and that's all very interesting. But I'm wondering if, because I know that you've been doing research more generally on the way that the financial institutions, the banking industry, the regulation of banks and so forth interacts with, labor markets and so on to either increase or decrease inequality amongst individuals. And I wondered if you want to say a few words about that.
Yeah, so there are a lot of debates about the role of the financial system in either expanding or contracting opportunities. This can get quite extensive, but you could think of sort of at one level, it tends to be the rich who use the financial services industry quite intensively. And so if you improve the financial services industry, it's going to be the rich that primarily get the benefits from that. At the same time, part of improving the financial services industry means expanding access to financial services, including the ability to start a business, expand a business. Although there were a lot of problems in the housing industry in the last decade, the ability to borrow might allow somebody to live in a community that's more conducive to the development of their children. So expanded access to credit markets can increase opportunities in a variety of dimensions, both in terms of, directly in terms of entrepreneurship, but also indirectly in terms of the environment in which somebody's kids are raised, and also whether you're looking for work in a dynamic economy where businesses are starting and opportunities are kind of, growing. So finance has a big impact on our lives and on what types of opportunities we have. And so then there are these debates. Okay, does this work? Does finance primarily work to intensify inequality? Does it tend to reduce inequality? And so...
Now, the kind of finance you're talking about here is more branches of the bank spread throughout a town so that people can get easy access to banking services, or is it, what is it? Is it lower interest rates so that people can borrow more cheaply, or more competition between banks so that the terms on which they, the interest rates they're paying on the savings accounts or the interest rates they're charging on the home loans will be more favorable for consumers if the banks compete? Exactly, what is the improved finance that you're talking, that you have in mind?
So the type of improvement in finance that I have in mind, I think primarily is oftentimes stimulated by competition, but it improves the services available to people. So what do I mean by services? So I might be just out of school. I have a pretty good income, and my employment prospects in terms of job security look great going forward. And I go and I want to buy a house because I want to live in a good school district for my kids. So the bank might look at me and say, well, your prospects look great, but I can't really evaluate your prospects very well. The only thing I can look at is how much accumulated wealth you have. And so that is related very much to perhaps my family background. And so then what you could have are situations in which I have this great future and I want to kind of invest it in a particular way, but I can't get access to credit markets because I don't have enough accumulated wealth. And so that is going to restrict my opportunities. If the financial system is better so that it puts less focus on whether I have collateral and accumulated wealth, and it puts more focus on evaluating my prospects, then it's going to allocate resources to those kind of with the best prospects, the best ideas, rather than to those with the most accumulated wealth, which might have more to do with my parents and grandparents rather than with what I am going to likely do over the next 20 years. So when I think about finance, I think about the degree to which it allocates credit based on prospects as opposed to allocating credit based on accumulated wealth. And that's why that's one dimension along which it can expand opportunities.
Okay, that's important, it seems to me. There's intermediation going on, right, between the people who could use funds and the people who are holding the funds. And you want, in an ideal system, for the funds that are available for investment to be deployed to the most promising projects. Those projects don't necessarily come attached to the people who have the most access to the banking system. To the extent that the banking system manages to figure out who has the best prospects and get the funds available for investment to those persons, that will be productive for the economy, and that may also reduce inequality.
Exactly.
However, there's a lot of reasons why a banking system might not work that way. There might be nepotism and corruption. There might be a monopolistic situation. There might be, I don't know what, just a set of traditions about, we do it this way, we're old-fashioned. There might be, we rely only on the people that we know or whatever. Anyway, I'm making this up. You're the expert. I should say.
No. I think that you're exactly right. And as I've mentioned to you, my motivation to work in this area comes from a paper that you published in 1981, where you sort of laid out there. You sort of took one tack in terms of making an assumption about finance, but what you laid out there is exactly this: that the finance is not a 0-1. It is there's sort of the degree to which the financial system functions well is partially defined by the degree to which it lends money to people with the best prospects as opposed to people with the most accumulated wealth. And so if it lends money to people with more prospects, this expands their ability to move forward, and it creates a more efficient allocation of resources. So theoretically, conceptually, it can go in very different directions. And so part of what I've been doing is working empirically to assess, under which circumstances does it tend to have a positive effect, and which circumstances does it tend to have a negative effect.
Well, I should let you tell us what the results are, but I first have to remark, you remember a paper I published 30 years ago? That paper influenced you? You're one of the most prominent economists in your field on the planet, and I'm just so honored that you remember my paper and that it had a little impact.
A big impact, not a little impact, okay. Very big impact.
Tell us about your findings. My paper is 30 years old. We don't need to talk about it, but I'm just so pleased that it proved helpful to you.
So I think that the findings that I have focus on the United States, and they ask a question about there was a period when the individual states of the United States, and this is in the 70s and the 80s, reduced impediments to banks competing with each other. When they reduced these impediments to banks competing with each other within a state, there's lots of evidence that this improved the banking system. So improved the banking system in the sense that we know that interest rate on loans went down, interest rate on deposits went up, so the profitability of banks went down as they competed to get more clients. The collateral requirements on loans tended to drop so that they required that people put up less money. So this is a sign perhaps that they were seeking out the best investments, not necessarily just the people with the most wealth. And at the same time, delinquency rates did not rise. So it's not just that they took on more risk and there were more bankruptcies. There seems to be an improvement in banking.
That's impressive.
The question that we asked was, what happened to income inequality when there were these improvements in the banking system in the United States? So we're not saying that whenever you reduce impediments on banks, it is always going to have these effects. So this is one circumstance. So we find that income inequality went down quite a bit when there were improvements in the banking system. And then we also looked at sort of why it went down. Is it because more people became entrepreneurs, or is there some other reason? And so what we find is that there's more entry into businesses, and there's more exit from businesses. And so this fits very much with the notion that with a better banking system, more people can enter, but some people are going to be driven out of business as you intensify competition. So if you have two people, one had a lot of wealth and wasn't very able, and the other person had not so much wealth but was very able, when you have the better banking system, more credit is going to go to the able person who didn't have so much wealth. His or her business will expand. The other business might actually go out of business. So you're going to have more turnover.
Yeah, what I'm finding so interesting here is that these businesses, these industries in which this entry and exit is occurring are not the banking industry. They are far from the financial sector, and yet the inequality or the access to them or the ability for good ideas to get in and bad ideas to be shown for what they are is enhanced to the extent that you liberalize the banking
sector. Exactly. So the effect is not on there's very few people work in finance, so the effect comes from everywhere else. Exactly. And so in the results, what we're finding is it's not so much that all of a sudden everybody becomes an entrepreneur, a business person, because on net the numbers don't change very much. But what does tend to happen is that this creates a more dynamic labor force. So what happens is it bids up the earnings and the wages of individuals, and that's what tends to reduce income inequality in the individual states, which is the economies that we're examining. So we find quite a substantial reduction in income inequality from this improvement in finance.
this improvement which has been brought about by the deregulation at the state level of the banking sector. And yet much of what we hear in the public conversation these days is about regulation or re-regulation of banks. So what do you have to say about that?
So we don't interpret our results as saying that deregulation is good. We interpret our results as saying that there were a set of regulations, a specific set of regulations that impeded competition among financial institutions. In the 70s, it actually goes from most of the 20th century, so it had restrictions on the ability of banks to open up branches across a state, or for banks to open up new banks or subsidiary banks in another state. So we had lots of regulations that protected banks and boosted the monopoly profits of banks. So not surprisingly, those restrictions stayed in place for quite a long period of time because the financial services industry tends to be very good at lobbying for what it wants. But for a variety of reasons, technology changed the pretext for those regulations. So you had the invention, for example, of ATM machines. And so an ATM machine, I open up an ATM machine where you have a bank. You say, no, you can't do that because there are restrictions on opening up a branch and the ATM machine is a branch. And I say, no, the ATM machine is not a branch. And you say, it is a branch. And then we fight about it. It goes to the courts. It actually goes all the way up to the Supreme Court. And then it decided the ATM machine is not a branch. So there are a variety of technological changes that reduced the usefulness of these regulatory restrictions on branching. It became easier to do branching at a distance because of technological changes. So then the regulations went away. There was more competition. So we're interpreting this deregulation as one particular policy change that intensified competition. I think that what's going on in the banking system now in terms of regulation is trying to get a mixture of regulations that does not encourage excessive risk-taking or bad behavior on the part of the financial services industry. So
stricter capital requirements.
Exactly. So I sort of view them. I interpret it as two different.
So that's differently than the thing that keep the banks from competing with each other kind of regulations. So you're not against all regulation, just against dumb regulation.
that's pretty. I think that's as safe as my statement that Republicans and Democrats both like money.
Well, the president said when he was running in 2008, I'm not against all wars, just against dumb wars, right? He was against Iraq, but he was in favor of Afghanistan. So it seems like it's an analogous kind of thing here. You're against the regulations that keep banks from being able to open up branches in each other's neighborhoods or whatever and drive down the cost of borrowing. But you're in favor of regulations that keep banks from being overly leveraged or, getting too big to fail and inducing systemic risk that then the taxpayers have to clean up afterwards. Yeah. Good. I'm glad we got that sorted out, Ross. Listen, I think we've had a wonderful time talking here. We'll do it again sometime. I thank you so much.
Thanks for inviting me on the Glenn Show, and good luck with everything.
Thanks so much, Ross. Take care.
Bye-bye.
Bye-bye.